Everyone, let's talk about another big tech company in focus today, Microsoft. Investors were a bit disappointed in the company's latest earnings results after the bell on Tuesday. Some analysts cited the high capital expenditures, or CapEx spending, Microsoft had in the latest quarter as a concern. So let's take a step back here, just breathe, define CapEx. It's short for capital expenditures, and it's basically the funds a company uses to acquire, upgrade, and maintain physical assets. So, why are investors so obsessed with CapEx spending, and why should it matter to investors like you? Here with the answer, we've got our very own Akiko Fujita. Hey, Akiko.
Hey there, Brad. Investors are watching that capital expenditure number closely because it's seen as an indicator for how much of this AI demand can continue. It also has a trickle-down effect. The more these big tech companies invest in AI infrastructure, the more compute resources for those startups who are looking to build out their AI capabilities. And we're talking about Microsoft, of course, because it is one of the biggest players in this space. The company spent a whopping $19 billion in CapEx, including financial assets, during the most recent quarter. And for some context, that is the same amount Microsoft spent in an entire year just 5 years ago. It's up 78% from a year ago. CEO Satya Nadella defended that number on the earnings call, saying that the demand signals, in his words, justify the spending. Specifically, he said cloud and AI-related spending represented nearly all of the company's CapEx in the quarter. And within that, roughly half went to infrastructure needs, with the remaining amount going to buy up CPUs and GPUs for its data servers. And CFO Amy Hood warned there's more spending to come, saying the company planned to invest even more on AI infrastructure in the next fiscal year, with CapEx in fiscal 2025 expected to be higher than that of fiscal 2024. So for investors, the question is when the company will start to see a return on these investments. And analysts appear to be split on this one. Those like Brent Thill over at Jefferies say spending in infrastructure needs like building and leasing data centers is justified, given that those investments will be monetized over the next 15 years and beyond. That's according to the company's estimated timeline. But analysts at Guggenheim say there's a lot that can change over that time, especially on demand, and that could affect their business. Their question in their most recent note: how can you trust management to predict what will happen 6 to 12 months from now if they have trouble forecasting the next 0 to 2 months? And of course, they're talking about the growth that came in through Azure that was lower than analysts expected. Microsoft results do point to monetization on AI starting to pick up, even if it's just a little. The company said AI services contributed 8 points to Azure's revenue growth. That's 1 point higher than where it was in the previous quarter. And Microsoft, of course, isn't the only one spending. We heard from chipmaker AMD in their most recent results on Tuesday, with $154 million in CapEx reported for the quarter. Compare that to $127 million that was expected. All the spending, of course, is measured against the market leader on AI, NVIDIA, particularly investments in their data center business, because that's what the market is chasing. And Brad, as you know, those results aren't expected until the end of the month.
All right, we're going to be watching closely. It has been the bellwether for past earnings seasons here. We'll see if that continues. Akiko, thanks so much. Appreciate it.